You're listening to the Home and Outdoor Living Podcast. I'm your host, Michael Garcia, and my goal is to educate you on various home living topics and provide you with actionable steps to take in your projects. If you're a homeowner, you're in the right place. On to today's episode. Welcome back to the Home and Outdoor Living Podcast. I'm your host, Michael, and today I've got a topic that has been coming up a lot lately. That is the topic of how to finance your home improvement project. As you may know, our company runs a family-owned landscape design and build firm. And throughout the course of the winter and leading on to today's current events, we have been asked the question several times about how payments or how financing should work for somebody's project. So there are 4 options that you have as a homeowner to finance or pay for your home improvement project. We are going to go through each one, and while at no point of this am I giving you financial advice, I am simply going to speak on my experience and the experience of my clients for what has worked well for them and the pros and cons for each one. So without further ado, let's dive in. So the very first option that's available to you to pay for a home improvement project is, of course, cash. As you may have heard of the phrase before, cash is king. It certainly is king when it comes to paying for your home improvement project, in the way that I mean that you have cash available to you and your contractor needs cash to get the work done. So if you have savings and you've been saving for a particular project, it's a simple transaction. You're going to give cash in the form of physical cash, a check, an email money transfer, a cashier's check, to the contractor that's going to do the job for you. Simple, very self-explanatory, not much more to it than that. The limitation with cash is that it can take you a very long time to accumulate the amount of cash that you need for your project. In the home improvement space, you've got simple home improvement projects, starting at, let's say, $150, for a service call for a plumber, all the way up into the hundreds of thousands of dollars, whether it's a custom home build or a full-on outdoor renovation, a home addition, you name it, that's in that category. So if it's a small ticket item, cash is the easy one, no brainer. But really for the bigger ones, the downside is that you might have to wait a lifetime until you can actually afford to pay for those things. So that is a true downside of it. The upside is you can't spend any more than you make because you had to save for it. So that is the pro to cash. The second option, credit cards. Credit cards are probably the easiest thing to use. It's a number that you give to your company over the phone. Here's my card. Process when you're done, or if it's in advance, and away you go. And you can simply log on to your banking and transfer your funds over when you're ready to do so. So in terms of speed, that's the easiest. Now, what's the downside to credit cards? They often carry very large interest rates on an annual basis. I've seen some as low as 10% per year, and some as high as 30% per year. Some of it depends on your personal credit score, and some of it depends on what type of card it is. So in terms of what different rewards does it have. Some credit cards are also tied to a line of credit or biz lines and that kind of thing. So the downside there is that the interest rate is really huge. So if you're not going to pay it off at the end of the month, you're going to run the risk of having very large carrying costs on that deal. So again, if it's just a simple service call from a technician, plumber, electrician, maybe it's a quick, easy transaction in that sense. but you're certainly not going to put a $50,000, $100,000 project on a credit card. Now, you certainly could as an intermediary. So as you're making progress payments, you're just paying it off right away because it's an easy form transaction and you're accumulating points maybe in the meantime. That is a pro to it. The con is you're not actually going to finance a project on a credit card. You may just use it as an intermediary between a credit and cash that you may have in your accounts. Aside from that, I'm not aware of any other benefits other than accumulating travel rewards, other points, cashback, dividends, and that might just be about it. Now, the third option is what is called an unsecured loan. In our landscape company, we offer one of these through a company called Finance It. They are a private lender and they lend for projects in the home improvement space. A lot of hot tub, pools, custom up to get the loan. So again, it's just based on your annual income and your credit score. So the interest rates usually on an unsecured loan, will range anywhere from 5 to 15% depending on who the lender is. Currently, Finance It currently offers 8.99% on home improvement projects up to $100,000. That is the limit. As far as I'm aware, you cannot get an unsecured loan above $100,000. Okay. Where does this come into play? Well, it's a really, really good way of financing a project without having to put up the collateral of your home or any other financial assets that you might have. So again, 9% basically per year, and you cover your costs over however long your term is. The cool thing about unsecured loans is typically you can decide what your term is going to be from 1 year to 5 years. You can decide on that time period with Finance It currently. And amortization periods all the way up to 180 months, 15 years. So between those two, between the term and the amortization period, there's a lot of flexibility to get the monthly payment to where it's most comfortable for you. Again, completely unsecure. So this can ride in addition to your current mortgage. Or you don't have a mortgage and you don't want to use it. And this is a really good way of budgeting for an item that can be a big improvement on your home, but also a big ticket item. Typically, when a homeowner is considering financing a project, so not cash or not using a credit card intermediary in the project, they will typically use a secured loan. A secured loan is such as a mortgage or an equity line of credit. So if you have an ongoing mortgage, you've got a locked in rate, and typically as your terms renew, you'll have equity in the deal that will now turn into your equity line of credit. When you have your mortgage completely paid off, your equity line of credit will be its largest, right? So just as when you get a mortgage, there's that ratio of what they're willing to loan you compared to your down payment. When you get your equity line of credit, the maximum typically that you're going to get is 80% of your collateral. So 80% of the current home value. A lot of homeowners that are in these financial positions will typically use their equity line of credit for their project rather than an unsecured loan, because the equity line of credit typically carries just a couple basis points over the current mortgage rate, and it is significantly lower than an unsecured loan. For example, at the time of recording, you can typically find an equity line of credit around 3.5%, where mortgage rates, fixed mortgage rates, are currently around 3% in Canada. So you can see it's 50 basis points above the current mortgage fixed rates. So that's the difference between the two. So typically when a homeowner at least in our experience, is considering financing a project, typically they're going to do it through either the equity line of credit or they're ready for refinancing. And if it's a large project, large investment project, such as $50,000 and up, typically they may refinance with that project in mind and roll it into their mortgage. Now, of course, as we've gone through here, you've probably started to formulate your own ideas as to what would make more sense for you if you're going to embark on a large home improvement project, whether it's a $10,000 plus new roof, whether it's a pool project, landscape project, home addition, sunroom, interior remodel, kitchen project, you name it. Depending on what you're going to do and what assets you have available to you financially will determine which one you're going to pick. And also based on your financial philosophy, right? So certainly over the course of my career so far, I've come across people that do not do any credit or loans whatsoever. Literally the only one they committed to in probably their whole entire life was their mortgage. They buy cars outright, they buy everything outright cash, and they've done projects over time to do it. Now, there are certainly those that understand how loans can work in their best interest. And I'll give you a really good scenario for this one. We are currently working with a client who is embarking on a very, very large exterior remodel on their recently purchased home. This home is going to be their forever home. When we are talking about a forever home and they are essentially renovating it to make it exactly the way they want, the best scenario is generally to secure that in a secured loan, either by refinancing their mortgage or in an equity line of credit. The reason for this is because the carrying costs for that project are very minimal. Say, for example, you take $100,000 cash and you're considering a $100,000 outdoor project. Well, if you're up for refinancing your mortgage or you have an equity line of credit of $100,000, or you'll get it in refinancing, and you lock that in, let's say today for 3%, you can take your $100,000 cash, and depending on what funds you have available to you, historically, even a conservative fund, will generate 5 to 8% per year on that money. Now, of course, that dips in and out. And again, this is not financial advice. So I'd talk to your financial advisor or wealth manager regarding this. But if you're going to come out ahead with the cash, then that's always a better deal than putting the cash outright. Now, again, this assumes that you know how this process works and that you can follow a plan and that you really stick to a budget and a whole other amount of factors. But again, when you're talking about your forever home and you are essentially paying a mortgage 25 years or 30 years, whatever the case is, it's always easier to roll it into that, especially when we talk about phasing a project. So, for example, if somebody is planning on a $200,000 home improvement project, but they only have $100,000 cash. But if they defer the other $100,000 of the project till next year or the next 5 years, over the next 5 years, the cost of that $100,000 project will inflate because of annual increases in the market, annual increases on materials and on labor and on equipment. So generally, that $100,000 project every year turns into, let's say, for example, $103,000. And then the year after that turns into $106,300. You see what I mean? It starts to get bigger and bigger and bigger. Whereas if you roll it into your mortgage, then those costs are hidden in the appreciation of your property in the market. So if I didn't make any sense to you, I apologize. It is a bit of a financial math, economics that are at play here. And again, if you really want to know what's at your disposal, talk to your financial advisor, planner, or wealth manager to really understand that if you are embarking on a home improvement project, what makes more sense for you. Again, it all will come down to your philosophy as well. So to recap, there are 4 ways to pay for a home improvement project. Number 1, cash, the easiest way. 2, credit card, the even easier way. 3, an unsecured loan through a private lender, such as a company like Finance It. And 4, a secured loan, typically done through a mortgage or equity line of credit. I hope this helps you determine what is available to you for your future home improvement project. Everyone's got that project that they really, really want to do on their home. And I know you're already thinking about it. And so I hope this helps you figure out how you're going to achieve it. I wish you all the best. Thank you for tuning in, and we'll see you next time. Thanks for listening. If you found value in this episode, you can support us for free by subscribing, rating, and reviewing this podcast. See you next time.